Welcome to The Explainer. Today we are digging into the latest inflation numbers. We're going to break down what they actually mean for you and for your wallet. All right, let's just jump right in. The newest report on the cost of living just dropped and, well, it's a bit of a head-scratcher. It seems to be telling two completely different stories at the same time, and it's got everyone from Wall Street traders to us regular shoppers wondering what to make of it all. So to really get what's happening here, we have to look at the main conflict that's baked right into this report. This is the part that's sparking all the debate. You're going to hear people, especially analysts, call this a mixed print. That's really just fancy expert speak for this is confusing. It means the data is pulling in two different directions. So let's unpack that puzzle together. The whole story really boils down to two key numbers. They both measure inflation, but they do it in slightly different ways. And those differences are super important right now. One number gives us a reason to be optimistic, but the other, well, it's a bit more concerning. First, you've got the big number you'll see in all the headlines. The annual inflation rate clocked in at 2.7%. Now, that was actually a little bit cooler than what a lot of economists were bracing for, and the market saw that as pretty good news at first. But then there's the other number. It's what economists call core inflation, and that one, it came in hotter than expected at 3.1%. That's actually the highest it's been since back in February, and it paints a very different picture of where prices might be going. So what's the deal here? Well, headline inflation is the one we all feel every day. It includes all the stuff we buy, like gas for our cars and food from the grocery store. Core inflation, on the other hand, strips out those really volatile food and energy prices. Economists watch this one like a hawk, because it helps them see if price increases are becoming permanent or sticky across the whole economy. So let's pop the hood and see what's really going on. We need to look at the specific things that are pushing these two big numbers in opposite directions. Because it's not just about the final percentage, right? It's about what's actually happening to the prices of things we buy all the time. And this table just lays it all out so clearly. You can really see the split. So on one side, you have energy prices, which actually fell by 1.1%, mostly because gas got a little cheaper. That helped pull that main headline number down. But then look at the other side. You've got beef, coffee, clothes, and shelter, rent, all ticking up, and that's what's pushing that core number higher. And to really understand that jump in beef prices, just listen to this from the CEO of Omaha Steaks. He says we're dealing with a cattle herd that's the smallest it's been in 70 years, while demand is through the roof. He flat out says he doesn't see any relief on beef prices coming until 2026 at the earliest. That's a long time. One analyst basically summed up the whole situation at the grocery store perfectly. Egg prices? They actually dropped in July, so that's great for your breakfast plans. But that steak dinner? Yeah, that's definitely getting more expensive. As you can imagine, all this conflicting information creates a massive headache for the folks whose job it is to keep inflation under control, the Federal Reserve. The Fed is literally looking at the exact same report and seeing two totally different ways forward. You've got one camp calling it a dovish print. That's their jargon for this gives us a reason to cut interest rates. But then you have others who are looking at that gap between headline and core, and they're saying, whoa, this makes it much, much harder to agree on anything. I mean, just think about the juggling act they have to perform. They've got the good news from the cooling headline number, but then there's the bad news of that hot and sticky core inflation. And on top of all that, they're starting to see a few cracks in the job market, and nobody really knows what the full impact of trade tariffs is going to be. It is a really tough spot to be in. So all of this, it brings us to a bigger and maybe more fundamental question that's kind of bubbling up. And it's one that affects not just what the numbers are telling us, but whether we can even believe them in the first place. Because simmering just underneath all this economic back and forth, a new and frankly pretty serious concern has popped up. And it's about the very source of all this information, the Bureau of Labor Statistics, or the BLS. You see, analysts are pointing to some major shakeups at the BLS. The agency's commissioner was fired not too long ago. They've had staff layoffs. They've even stopped collecting data entirely in 3 metro areas and have cut back on collection in 15% of the country. Put it all together, and it's got economists worried that future reports might get, as they put it, a little bit cloudy. And this really, really matters. It's not just some inside baseball thing for economists. As markets reporter Madison Mills points out, having data from the BLS that everyone trusts to be nonpartisan is critical. Global markets and the people moving billions of dollars depend on that trust to make huge financial bets. So here's the real takeaway. Trying to get a read on inflation has suddenly gotten a lot more complicated. It's not just about arguing over what the numbers mean anymore. Now it's also about questioning the trust we have in the institutions that give us those numbers. And that leaves all of us with a really tough question. If the yardstick we're using to measure the economy is getting cloudy, how can we ever be sure of what we're actually seeing?